Share prices change every day due to countless stock market forces. With share prices changing multiple times per second, it's almost impossible to keep up with the market movements as a non-professional. Of all the forces that move and manipulate the market, the rudimentary economic principle of supply and demand is the strongest at the end of the day. When lots of people are interested in buying a particular share, the demand for the share goes up and the price of that share also moves up proportionately. When many people are selling a particular share, the supply exceeds the demand and the share price drops. While it is easy to understand the basic principle of supply and demand, it is very difficult to find out why people decide to buy a particular share and sell another. And if you decide you want to learn to be a trader, the why is very important to you and will be a large part of your trading plan and methodology. But for investors, the why isn't all that important since our focus will be on the operations and health of a company rather than market sentiment. But we'll get to more on the details and the differences between traders and investors later. Now, we could spend an entire course attempting to identify and discuss the different factors that move the markets. So, in the interest of time and simplicity, we'll just touch on the three most common factors that influence non-professional investors and traders as they make buy and sell decisions. And as cynical as it may sound, professional traders are often on the opposite side of non-professionals' trades and investments, buying when the public is selling and selling when the public is buying. And we'll look more on how this works in a bit. The easiest way to find out whether or not people are going to like or dislike a stock is to review current news about the company of that stock. And if any news is favorable to the company, then the positive sentiment will most likely be represented in the market, and specifically the stock's price, pushing the share price up. However, when news is adverse, the negative mood will set in and it will push the price of the company's stock down. This is true because in the short term, news developments have the greatest impact on share prices, and you can do this without needing to know any chart patterns or technical analysis, which we'll also get to later. Now, this may seem like an oversimplification of determining general market sentiment, and it is. The reality is, unless you devote hours a day understanding the full implications of the driving factors behind a stock's price movement, is essentially impractical. Now, I want to add a warning to any of you out there who are looking to use the news to make trading and investment decisions. And this is the harsh reality you and I face. Professional traders will be out of a trade by the time the news comes on the TV. The professionals set up their trades before any news reports hit CNBC or Bloomberg. And in fact, they use the news to exit their trades. And when the general public decides it's a good idea to jump in, that's when they jump out. And they pay thousands of dollars a year for news sources that will give them the inside scoop before any television talking head can tell you what's really going on. And this keeps them a step ahead of the general public. For this reason, if you plan on trading, don't expect to strike it rich trading the news unless you too have thousands of dollars a year to purchase these inside news sources. Now, one of the major news items that investors and traders watch for are company earnings reports. Reported on a quarterly basis, companies release 3 interim financial statements and 1 annual report each year. The price fluctuation of stocks around this time tend to peak as investors and traders anticipate good news or bad news in the company's financial statements. Now, in most cases, the company's earnings announcement is only half of the picture, and the earnings numbers matter only in the context of analyst estimates. However, the reports are only a result at the end of a guessing game. The real driving force behind the stock's price fluctuations around reporting periods are the analysts' expectations of the earnings. So, analysts usually predict the amount of profits or losses a company will make. And these predictions are the real driving forces behind a stock price's movement around earnings announcements. This often results in a strange phenomenon. More often than not, when a company meets its earnings projections, little happens to the price because the expectations of the positive results have already been factored into the stock price before the earnings were ever announced. Those who bought the stock are just waiting to be right or to sell it to those who are buying at the last minute before the earnings announcement. On the other hand, when a company's earnings fall short of expectations, even if it's only by a couple of pennies, the stock price will drop dramatically because the minimum expectations weren't met.